On Friday, the Bureau of Labor Statistics reported that the U.S. economy added 57,000 jobs in June. That number is well below the 115,000 number that economists were expecting, and it's the weakest print in 4 months. On top of that, April and May were actually revised down by a combined 74,000 jobs. At the same time, the BLS reported that unemployment has actually fallen from 4.3% down to 4.2%. But wait a second, fewer jobs were added, but unemployment went down? On the surface, that sounds like good news, but it's actually the opposite. That drop happened because the labor force participation rate fell to 61.5%, which is the lowest level since March of 2021. People aren't finding jobs and getting counted as employed. They're leaving the labor force entirely and are no longer being counted at all. And that's really the theme of today's video. Almost every number coming out of this labor market report, it looks fine on the surface, but it falls apart the moment that you look at the plumbing underneath. So in today's video, I want to walk through 5 different layers of this jobs report. First, we're going to talk about the headline number. Then we will discuss the shift from full-time to part-time work. After that, we're going to talk about who's actually capturing the job growth in this market, what's happening to wages sector by sector, and then finally, which industries are strong and which ones are quietly breaking. So let's get into it. So let's start with the headline. The Current Employment Statistics Survey, which is the fancy name for the BLS Nonfarm Payroll Data Program, says that the economy added 57,000 jobs in June, as I mentioned. These job gains, they were very concentrated, and they were concentrated in professional and business services, up 36,000, social assistance, up 25,000, and healthcare, up 22,000. Leisure and hospitality actually lost 61,000 jobs. And that's notable because Goldman Sachs had expected the World Cup to give hospitality hiring a boost for this summer, but clearly that didn't show up in the numbers. And I want to discuss something that I found interesting. For the month of June, the household survey, which measures actual individual employment status rather than corporate payroll counts, it showed some rough data. Household employment fell by roughly 500,000 people in June. So basically, 2 different government surveys released on the same morning are telling 2 different stories. The Current Employment Statistics Survey, it says that the economy is adding jobs, while the household survey says that fewer Americans are actually employed. This gap is something that I want to touch on further. I mean, why does it exist in the first place, and why is this gap widening? A big part of the answer is something most people have never heard of called the birth-death model. And so here's how that works. The CES survey can only sample businesses that already exist and are already in the government system. But new businesses open every month, and there's a pretty long lag before a brand new company shows up on the BLS's radar. So to account for that blind spot, the BLS runs a statistical model that estimates how many jobs new business formation is adding. And this is based on the historical trend of past business births and deaths, and it adds that estimate straight into the headline number. The problem, though, is that that model assumes new businesses are being born and hiring at something close to their historical average pace. It doesn't know in real time whether that's actually true or not. And we've seen this model be wrong before in a big way. Looking back at the second quarter of 2024, actual job losses in the private sector were reported at 163,000 jobs. But over that same quarter, the birth death adjustment alone added 683,000 jobs to the top line numbers. That is not a small statistical rounding error. That is the model assuming healthy business formation while the real economy underneath it was contracting. Now think about the environment that we're in right now. Interest rates have been higher than they have been in the past decade for an extended period of time, small business bankruptcies have been elevated, and capital for new startups is harder and more expensive to access than it was just a few years ago. If the birth-death model is still assuming new businesses are forming at a historical trend pace, it is very likely overstating how many phantom jobs are being created every single month. And that's a meaningful part of the answer to our question. It's why the headline payroll print can look resilient, while the household survey, the one that actually tracks real people, keeps showing something closer to stagnation. Now, before we get into the full-time versus part-time split, there's data that sits underneath the headline number that explains why unemployment can look calm even while hiring is weak, and that's what's happening with quits and layoffs. According to the latest JOLTS data, the quits rate is sitting at just 1.9%. This number has been essentially unchanged for months now. The layoffs rate is sitting at 1.1%, which is also barely moved. On the surface, low layoffs sounds like good news, and low quits sounds like people are happy with where they are. But I think what we are actually looking at is a labor market that is frozen solid in both directions. Workers aren't quitting because they don't trust that a better opportunity is waiting for them on the other side. The quits rate is one of the best real time signals of worker confidence that exists. Because people only leave a job voluntarily when they believe that they can do better. And right now, they don't believe that, so they're staying put in roles that maybe they would have normally left months ago. And at the same time, employers aren't laying people off. And that's not generosity on their end. A lot of companies got burned during the hiring crunch of 2022 and 2023. During this time period, finding and training replacement workers was very expensive and it was a slow process. So instead of cutting staff at the first sign of a slowdown, employers are hoarding the workers that they already have, even if there isn't necessarily enough work to justify the headcount. Now, that combination, frozen quits and frozen layoffs, is exactly why the unemployment rate can hold steady or even improve while the actual hiring in this economy, as we saw with that weak headline payroll number, is clearly losing momentum. Nobody's really getting pushed into the unemployment column through layoffs, and nobody's voluntarily walking into it by quitting to search for something better. The churn that normally keeps a labor market healthy, people moving from worse jobs into better ones, has essentially stopped. And a labor market with no churn, it's not a strong labor market, it's a labor market that's stuck. Now let's move past the headline number and look at the quality of the jobs actually being created, because this is where the story unfortunately gets worse. Headline payroll data treats every job as the same. A newly created 40-hour-a-week corporate position with benefits counts the exact same as someone picking up a part-time role just to make rent. The headline number doesn't care about the difference at all. And since the pandemic shock back in 2020, we've seen a major shift in how Americans are working. The share of people working multiple jobs just to get by has been sitting above 5% of total unemployment for 30 straight months. That's the longest streak at this level since 2009 in the aftermath of the financial crisis. Right now, roughly 8.5 million Americans are working more than one job simultaneously, and the number of people working part time for economic reasons, meaning they want full time work but just can't get it, is sitting at around 4.7 million. Now let's talk about the demographics of the American workforce based on the numbers. The most recent annual data on foreign born versus native born workers shows that a real divergence is occurring. The unemployment rate for foreign born workers has held steady year over year at 4.2%, while the unemployment rate for native born workers has actually risen from 4% up to 4.3%. So over the same time period, one group's job prospects has held flat, while the other groups got measurably worse. And labor force participation tells a very similar story. Foreign-born men participate in the labor force at a rate of nearly 77%, compared to just under 66% for native-born men. That's more than an 11-point gap. And on pay, foreign-born full-time workers had median weekly earnings of just over $1,050, compared to about $1,236 for native-born full-time workers. If you put this all together, you get a labor supply curve that's shifting in a specific direction, with participation and employment growth increasingly concentrated among foreign-born workers, while native-born unemployment drifts higher. Now let's get into pay, because this is the part that determines whether any of this job growth actually translated into a better standard of living. Headline average hourly earnings came in at $37.64 in June, which is up 13 cents or 0.3% for the month and up 3.5% over the past year. On paper, that sounds like decent wage growth, but that's the nationwide number, and it hides where the money is really flowing. Real inflation-adjusted average hourly earnings have essentially been flat to slightly negative in recent months, meaning wage gains are barely keeping pace with or actually losing ground to the cost of living. And when you break that number apart by sector, what we find is actually quite worrying. Look at where the actual hiring strength in this report is concentrated. Professional and business services, which includes high skill, technical, and engineering roles that are tied to things like the AI infrastructure buildout, has now added 172,000 jobs since its low point in October of last year, and it was the single strongest category in this month's report. Healthcare keeps adding jobs month after month. These are sectors with genuine demand, and that demand is what keeps wage growth sticky and elevated for these workers. Now compare that to leisure and hospitality, which just lost 61,000 jobs in a single month. In a period when hiring should have been getting a seasonal and even a World Cup related boost. That is a sector where labor demand is visibly softening, and soft demand for labor is exactly the condition that flattens wage growth. When the industries that employ the most entry level and lower wage workers, think retail, hospitality, and so on, when these are the ones shedding jobs or barely growing, those workers have almost no bargaining power to demand raises that keep up with inflation. On the other hand, workers in high demand technical fields are still commanding real wage growth because the employers in those sectors, they're competing very hard for talent in this AI build-out race. That earnings gap is the real story behind the average hourly earnings headline. It's not that wages are broadly keeping up with inflation, it's that a shrinking slice of high skill, high demand workers are keeping up just fine, while a much larger slice of the workforce, especially younger and entry level workers that are concentrated in consumer facing industries, they're working the same hours for purchasing power that is basically eroding in real time. So let's bring this together sector by sector. On the strong side, professional and business services, which as I mentioned is absorbing the AI infrastructure and advanced technical hiring boom, they continue to be the clearest source of job demand in this report. Healthcare keeps adding jobs nearly every month, regardless of what the broader economy is doing. Special shout out to the aerospace and defense sector because they continue to benefit from multi-year government and private capital commitments that are not showing any signs of slowing down. And then on the weak side, leisure and hospitality posted the worst single month loss in this report, and that's an industry that's extremely sensitive to discretionary consumer spending. Commercial real estate also remains under pressure because of the higher for longer rate environment that, as I mentioned in my FOMC meeting breakdown video, it doesn't seem to be going away anytime soon. And retail and lower tier commercial banking are actually both exposed to the thinning consumer spending power at the bottom of the income spectrum as well. And then they also have tighter capital costs at the top of their balance sheets with higher interest rates. So here's the bottom line. In many instances, the headline payroll number is not a very useful piece of information because it is distorted by modeling assumptions like the birth-death adjustment, and the least connected to what is actually happening to the people living inside the labor market. If you want a real read on this economy, you have to go past the headline and look at the household data, the full-time to part-time mix, who's actually capturing the job growth, and where wage growth is sticky right now, and then where is it flattening out. Right now, that combination points to a labor market that is split. The labor market looks strong in a small number of high skill and high demand sectors, but it seems to be deteriorating almost everywhere else. That's going to be it for today's video, guys. Let me know what your thoughts are in the comments. Thank you for watching. If you found this interesting, drop a like on the video, subscribe to the channel, and check out my other content. Once again, thank you all for watching and for the support on all my recent videos. I will see you in the next one.